Hello and welcome back to the channel. Today we're re-diving into some pretty significant news coming out of the UK government that could affect millions of households. The Chancellor, Rachel Reeves, has been speaking at a business summit in Saudi Arabia, and her comments are giving us a strong indication of what to expect in the upcoming budget on November 26th. Let's break it down. The big headline is that while businesses might be spared new, heavy taxes, ordinary households could be facing tax rises. Why this distinction? Well, you might remember last year's budget, where an increase in national insurance on employers was heavily criticized. Many experts and business owners claimed it hampered economic growth, particularly hitting sectors like hospitality and our local high street shops. It seems the government has listened to that feedback. Speaking in Riyadh, Ms. Reeves emphasized that economic growth is now the absolute #1 priority. She was quoted as saying, "I am not going to do anything in the budget that reduces our opportunities to grow the economy." That's very important. So, if businesses are being protected to encourage growth, where does the government find the money it needs? This is where it gets a bit worrying for the rest of us. The Chancellor has signaled a need for fiscal consolidation to get the public finances in better shape. And if you're not taxing businesses more, the logical next step is to look at households. The pressure is mounting because the government has been hit with a massive £20 billion blow. This is due to the Office for Budget Responsibility, the UK's independent fiscal watchdog, changing its forecasts for the country's productivity. Lower productivity means a slower growing economy, which in turn means less tax revenue than previously expected. This creates a significant financial hole that needs to be filled. So, what are the options on the table? Several measures have been rumored, and none of them are particularly cheerful. One possibility is a direct increase in income tax, perhaps by 1p or 2p in the pound. Politically, this would be a huge gamble. It would be a direct breach of a key promise made in Labour's 2024 election manifesto not to raise income tax. So you can imagine the backlash. A more subtle, and perhaps more likely approach is something called fiscal drag. This is when the government freezes the thresholds at which people start paying income tax and the higher rates. Normally these thresholds rise with inflation. By freezing them, as wages go up over time, more and more people are dragged into paying tax for the first time, or pushed into higher tax brackets. It's a stealth tax, because your tax rate doesn't officially go up, but you end up paying more tax anyway. Another idea being floated is a new, higher council tax band for expensive properties. This would disproportionately affect homeowners in London and the southeast, where property prices are highest. We've also heard talk of a mansion tax. This could mean owners of homes worth over £2 million would face a yearly charge, maybe 1% of the value above that threshold. Pensions could also be in the firing line. The government could decide to cut the tax relief given on pension contributions. This is a very valuable benefit, especially for higher earners, as it effectively gives you a government top-up on your retirement savings. Reducing it would be an easy way to raise a lot of money. Similarly, taxes on unearned income, things like dividends from shares or capital gains, could also be increased. It's not just homeowners and investors who might be affected. The Chancellor is also reportedly considering tax hikes for professionals like lawyers and accountants who operate as limited liability partnerships, or LLPs. Currently, they are treated as self-employed and don't pay employers national insurance. Changing this rule would bring them in line with regular employees and generate more revenue for the Treasury. Now, you might be thinking, why not just tax the rich more? It's a fair question, and it was put to the Chancellor directly. Her response was interesting. She said, "We did increase taxes on the wealthy in the budget last year, but there are limits." She explained that as Chancellor, she has to strike a delicate balance. While the government needs to bring in money, she warned that hiking taxes on the wealthy too much can reach a tipping point. At that point, capital gets repelled, meaning wealthy individuals might move their money or even themselves abroad to avoid the higher taxes. This is the classic economic argument against very high taxation on top earners. So, what is the grand plan here? What's the vision? Ms. Reeves made it clear that her core focus is on stability. She said, "Getting economic and fiscal stability is the absolute bedrock. You can't have any plan for growth that is not built on that basis of stability. That's why the government is embarking on this journey of fiscal consolidation." She pointed out that the UK is spending too much money just servicing its debt interest payments, money that could be better spent on productive investments. She also seems to want a bigger financial cushion, what's known as fiscal headroom. Currently it's about £10 billion. That sounds like a lot, but in the grand scheme of a national economy it's a very thin margin. Any unexpected event, another global shock or economic downturn, could easily wipe that out and throw all the government's plans off course. By making these tough decisions now, she hopes to build a more resilient financial foundation for the country. As she put it, in the budget next month, we will be making further decisions to ensure that our public finances are on a firm footing in the very volatile world in which we live today. Economists estimate the shortfall the Chancellor needs to fill is somewhere between £20 billion and £30 billion. Maybe even more. A big part of this is due to those downgraded productivity forecasts. Ms. Reeves acknowledged that Britain's productivity improvements have been very poor, and she partly blamed the lingering effects of the 2008 financial crash and Brexit. Despite the financial pressure, she was firm that she will not abandon her fiscal rules, which means she won't simply borrow more money to fund public services. That means there's no magic money tree for the NHS, the crisis-hit prisons, or the struggling transport network. The money has to come from somewhere, which brings us back to the potential tax rises. When asked what the UK's Vision 2030 would be, similar to Saudi Arabia's ambitious plan, her answer was surprisingly simple: making it easier to get things done in Britain. When pressed that this didn't sound very aspirational, she explained that it would actually be a huge change. She argued, "It takes too long for things to happen in the UK. If you are a business and you want to invest, you want to know your capital is not going to be tied up for years." Her vision is to unblock the system and make the UK a more attractive and efficient place for investment. So, to sum it all up, the government's top priority is economic growth. To achieve this, it plans to avoid new taxes on businesses. However, a £20 billion plus hole in the public finances needs to be filled. This means tax rises are almost certainly on the way, and they are likely to fall on households. The options range from freezing income tax thresholds and raising council tax, to new taxes on expensive properties and changes to pension relief. The Chancellor's goal is to create fiscal stability and a bigger financial cushion to weather future shocks, all in service of a long-term plan to make it easier to invest and get things done in Britain. It's clear that some difficult decisions are ahead, and the budget on November 26th is going to be one to watch very, very closely. We will be covering it live right here on the channel, so make sure you're subscribed so you don't miss our analysis. What do you think of these potential changes? Which one would affect you the most? Let me know your thoughts in the comments below. Thanks for watching, and I'll see you in the next video.